Hey everybody, Jason Russell. Just wanted to touch base and give you a mortgage market update today. This is going to be a kind of a longer video because I think there's a lot going on and in the weeds, and a lot of you guys are sitting at home with nothing to do. So maybe you want to watch a longer video. We'll see. So first thing I want to do is I saw this video online yesterday. It was this really angry dude from I think assume New York, and he's all fired up about getting that the government assistance money is not enough, and they should be banks should be pushing out mortgage payments and credit card payments and auto loan payments and all this because they've got the money, etc. That feels good to hear, honestly, for all of us who are struggling right now with all that's happening. But I think it's important that you understand what's happening in the back. Now, I can't speak for auto loans, I can't speak for credit cards, etc. But what I can speak to is mortgage. So the first thing I want to do is kind of explain how a mortgage transaction works. So let's say you, the person watching this, you're the client. You're the person who wants to come and get a mortgage, either purchasing a home or refinancing a home. I am the servicer. Okay, I am an independent mortgage banker. I am the person that can help you get a mortgage, either a purchase or a refinance. So you want to borrow money to buy a house or refinance a house, and I have money to offer you now and to lend to you. Now, that money that I have available to lend is held on what are known as warehouse lines. These are basically huge lines of credit, tens of millions to hundreds of millions of dollars, sometimes more, depending on the servicing size. And basically, these are other investors that that look at me as the mortgage company and go, you know what, you do really great loans and it's a great business relationship, so we're going to give you a line of credit to do this, to lend this money. So I lend money from my warehouse lines every single month. Now, the size of my warehouse lines are granted. This is granted to me based on the financial health of my organization, and that is an important point that I'll come back to later. So we go through the process. You find a house, you buy the house, you find the one you want to go to buy. You go through the mortgage process. We talk about your income, your assets, your credit, the whole thing, and I then take the money from my warehouse line and I give it to the current owner of the property, okay, to buy the house. You're now the owner, right? You think it's done, but there's a lot that then happens from there, okay? So once you make your first payment to me, I then take your loan, the money that I took off of my warehouse line, let's just say $400,000. I lent you $400,000. I take that money and I basically am giving your loan to a government-sponsored entity known as Fannie Mae or Freddie Mac. They securitize mortgage loans, okay? Because we don't, as big as my warehouse lines are, there's $10 trillion of mortgages in America. I don't have that kind of money to just be lending, right? So I take the mortgage that I originated, my 400,000, I sell that mortgage to Fannie Mae or Freddie Mac, government-sponsored entities that securitize mortgage loans. They then pay me, okay? They give me the $400,000 back. I then put that $400,000 back on my warehouse line, my credit line, and now I can lend that $400,000 to the next person in line, okay? So this is a process that repeats itself. And in this process, Fannie Mae pays me somewhere around 0.25%. So let's say your interest rate is 4.25%. Fannie Mae, Freddie Mac is keeping 4%. I, the servicer, am keeping 0.25%. And in exchange for that 0.25%, I am sending your bills, I'm setting up your online payments, I am your customer service, I am paying your property taxes, your homeowner's insurance, all that stuff, right? So I get paid for that. And assuming that the 0.25% that I earn in interest goes far enough to pay for the cost of workers to do all those things I just said, then my servicing portfolio is profitable. Okay, my company is making money because I'm getting more in interest of your 0.25% than I am spending to send you mail, answer your phone calls, pay your property taxes, etc. Okay, so I am making my profit as a mortgage lender in a couple of ways. One, I'm getting a percentage from the servicing side from Fannie Mae. That's an ongoing kind of stipend, if you will, that I'm going to get every month. And then in addition to that, I get some money from Fannie Mae when I sell the loan to them in the first place, because they're going to make 4% in interest over 30 years. They'll give me a little bit up front, and that's how I make my money. Those two ways. Okay. So I'm interested in originating new loans, and I'm interested in servicing loans that already exist. So that is the general way of how mortgages work. Now, if you, as the client, come to me and say, I can't make my payment this month, I, as the servicer, am still responsible for sending the money that you would have sent to Fannie Mae, because they have investors on the backside that need to get paid. So I am the servicer, have to take care of that money. I'll work with you to figure out how long it's going to take for you to pay me back. Do you need to skip a month's payment? Do we need to stretch it out over time, etc.? This is not usually a huge deal. This is something that's baked into my business model, and I'm prepared for it. So I have to pay that regardless. And this is, again, not a huge issue when the mortgage delinquencies are where they were 2 months ago, which is, in the right around 1% of all conventional loans were seriously delinquent. So I have money set aside for this eventuality. It's no problem. So now we run into this COVID-19 thing. This came out of nowhere, right? A lot of you watching are like, I didn't even know, who could have imagined this was coming? I wasn't prepared. I didn't have savings, etc. Your businesses are in the same way. You're seeing restaurants go upside down. You're seeing them go out of business, all these kinds of things, because nobody was prepared for a rainy day when nobody saw any clouds coming, right? So part of what the government did when they came out with a solve is they came out with this CARES Act. And they basically said to everybody out there that if you need to hold off on your mortgage payments, you can do a forbearance, which is the idea of not making a payment this month and making it up later. You can do that for up to 12 months. Well, nothing changed, however, for me, the servicer, right? I still have to pay Fannie Mae, even though you're not paying me. So I have to dip into a lot of my own personal savings, if you will. And again, this is not comfortable, because we were just at 1%, and as of, I think, yesterday, over 5% of all mortgages have now requested a forbearance. So we've now had a 500% increase in less than a month of payments that I, as the servicer, have to send to Fannie Mae. Now, Ginnie Mae, which backs government loans like FHA, VA loans, USDA loans, they set up a liquidity facility to make this a simple thing for me as a servicer. They're like, look, you can come over here. We got some money from the Federal Reserve. We'll take care of those payments. You guys get them back later. We'll put them on the back of the loan. We'll do something. So those government-backed loans, they gave us an out. But Fannie and Freddie, which are supposedly private entities, but have been in government conservatorship since they almost failed in 2008, are basically offering no solve for this, right? So if we're at 5+% in forbearance now, and we've got May's payments coming up, that number is only going to grow. Okay. So what that basically means is the servicing arm of my business, right? The part of my business where I'm going, okay, I'm going to collect payments, get my little 0.25% interest, and I'm going to turn around and make some profit on that. There's no value in it, right? Because I've got to be sending money all over here to Fannie Mae. The 0.25% interest that I'm getting was not meant to be able to carry a 5+% forbearance percentage, and with no end in sight, right? Like, the government didn't say you had to show hardship. They just said this could be up for 12 months. So I, as my company, my servicing company, could have to send up to 12 months of my entire portfolio, which in many cases is 50 billion, 80 billion, 100 billion, Quicken's probably even more than that. And I have to send that money regardless. Okay. So that's a scary thing for servicing companies. So in other words, that part of my company has no value. Now, this goes back to my point earlier about my financial health, right? My warehouse lines, the money I have to lend to the next person who wants to get a mortgage, is based on my financial health. Well, my financial health has gotten worse because my servicing portfolio has no value. So what happens then? My credit lines get cut. My warehouse lines get cut. So now I have less money to lend to the next person in line. So, which we'll talk about those problems in a minute. Now, in addition to being forced to pay out Fannie Mae, Freddie Mac over here, in order for me to get my money back from them in the first place, you have to make your first payment. Okay. So if you don't make your first payment, I can't sell the loan, your $400,000 loan. I can't sell it to Fannie or Freddie to begin with. And therefore, if that doesn't happen, the $400,000 on my credit line that I had to lend to the next person is held up because I have your loan sitting on it, and I can't get it. I can't sell it anywhere to free up that $400,000 elsewhere. So this has been a big problem because there's been a lot of people who originated loans in February or March, and their first payment was due in April or May, who obviously, with all this going on, are not going to be able to make that first payment because they've lost their job. They've been told that forbearance is just call us, we'll give it to you, etc. So now, in addition to having to forward all these payments, I also have got a bunch of loans tied up on my warehouse line that has been shrunk in many cases because my financial health is not so good because of the servicing problems we already talked about. So I've got issues on all these different fronts, and this is leading to what's being considered a liquidity crisis. There's not enough money to go around, right? I'm worried about having enough money to forward all these payments. I'm worried about having enough money to lend to more people to help me make money to make those payments. There's a lot going on. Okay, so what the industry has been begging for is for Fannie Mae and Freddie Mac to do something similar to what Ginnie Mae did and provide a facility, because they have access to unlimited funds essentially through the Federal Reserve, to be able to help make sure they're making the payments. Remember, this is their loan. It is a Fannie Mae loan. My servicing company, is just collecting the payments. They collect the interest. They collect, well, the vast majority of the interest. So why are they not forwarding your missed payment on to the eventual investor? They have the ability to do it, and they have the size to be able to do it. The head of the FHFA, Mark Calabria, he's a huge libertarian, so he's not into government bailing out private industry, which is odd for a guy who's running the government department of bailing out private industry, but that's a whole separate point. Either way, we were looking for a solve. So FHFA came out today, and the headline is like, oh, they're helping out the mortgage industry. Yeah, that's not what they're doing. They gave a little bit of clarity, but not much. So what they basically came out today and said, we will take your loans even if they're in forbearance. So in other words, those people who've missed their first payment, you can sell them to us, which will free up that money to lend to other people on your warehouse line. Great. You can put that money back in the market. That sounds great. We were all excited when we heard this, because this has been a huge problem for our industry over the past 45 days. Well, then we read the fine print. In order to sell your $400,000 loan to Fannie Mae, which again is their loan, in order for us to deliver it to them so we can lend $400,000 to someone else, we as a servicer have to pay 7% of your loan balance. Okay, 7%. So on a $400,000 loan, I as a servicer have to pay Fannie Mae $28,000 in order to free up the cash over here on my warehouse lines. We don't make that much. We don't make near that much money when we sell the loan. There's nothing there to make me willing to do that, unless the only reason I would do this as a company is if I'm literally going out of business. Okay, so this did nothing. It was terrible. So 15 minutes into this video, you're like, what the hell do I care about some servicing company, right? I have my own problems. Like, we're losing jobs over here. People are sick. Totally get it. I get it. I do. But I just want to point out, especially for those who are 15 minutes in. And if you're 15 minutes in, you're probably in the real estate business of some sort. This matters to you for a couple of reasons. Number one, the cost that is passed on from Fannie to the servicers, where do you think that cost is going to be passed on to? It's going to be passed on to the consumer. Now, how can you do that? I already got my mortgage from you. My mortgage is 4% or whatever it is, and so you can't change those terms. You're right. What I can do is change the terms of everybody else that's in line to get a mortgage. Okay? This is already happening to a certain degree. Rates are much higher than they technically should be based on bond prices, based on MBS prices, the things that normally drive mortgage rates. Where those numbers are at, rates should be significantly better than they are today. That spread is only going to increase as this goes on with no end in sight. So that's number one. Number two, if these servicing companies go out of business, which they very well could, depending on how long this goes on for, especially if there's another COVID wave in the fall to go along with a flu bug, and we have all kinds of other stuff going on where we got to shut down again, your servicing rights will be transferred probably to a large bank, Bank of America, Wells, Chase, because they have money in their deposit institutions, right? So they have your checking account, they have your savings account, they have your CDs, all those things. So they have money to pass this, to take from over here and lend it to themselves. Well, let me tell you, I worked at one of those big banks for 8 years, and I did loan modifications for them. You do not want your mortgage there when there is a problem. I assure you. You will deal with a nightmare. If you've tried to get a forbearance already and you've had a problem getting through to someone at an independent mortgage banker, wait until you get a hold of these big banks. It is going to be a nightmare. Good luck with that. And then finally, the process for getting a mortgage, if you're one of the people in line looking to refinance or buy a house, the process of getting one is going to become a massive, forgive my language, pain in the ass, because lenders are going to have to go, I have to double, triple, quadruple check that this person is not going to go in forbearance, and I can sell this loan to Fannie Mae so I can lend to the next person. So they're going to be asking you for so much documentation. It's going to remind me, I can already see, it's already going to be 2008, 2009, 2010 when they wanted your firstborn child in order to get a mortgage. That will happen again, I assure you. So that's not good for anybody trying to sell a home to somebody who's got to get one to get a mortgage like that, or to sell a home and buy another one to get a new mortgage. None of these things are good, and it's easily solvable. This is Fannie Mae and Freddie Mac's debt. It's their mortgages, okay? They have the money, and if they don't have the money, they have access to the money through the Fed to be paying the investors, okay? They should be the ones handling it. So I'm not the type normally to be like calling my congressman. That's not really my vibe. I just complain on social media. But I did. I wrote Congressman Garamendi. I wrote Senator Harris and Senator Feinstein to please do something. I think personally Mark Calabria should be fired for cause. He absolutely deserves it for his arrogance and obtuseness. But even aside from that, even if it's just putting political pressure, and this will likely need to come from folks on the right side of the aisle who tend to be more conservative with government help, fiscal policy. So if anybody's watching this in a red state, you could do a lot of good by putting a phone call into your representatives. But this is crazy, and like this is going to cause a housing crisis. We don't need a housing crisis for nothing. Housing is strong. Your values are strong. We don't need to go down this road. It's simple. We just have to not be obtuse and just stuck in our ways. This is a national crisis. You weren't ready for it. I wasn't ready for it. Businesses weren't ready for it. The government has an easy solve here. They're going to get their money. It just may be 12 months from now, and everybody can be good. But it sounds like we need to push harder. So long video, but I felt like it was really important to explain some of this for those in the real estate industry to know what we're up against and what could be coming down the pipe. So hope you guys have a great day. and talk to you soon. Thanks.